I think that what we're going to have for 2025 is what I call a Clint Eastwood market. There's going to be good, there's going to be bad, and there's going to be some ugly. This is not going to be an easy market.
Larry Williams, the legendary trader that holds the record for the largest return in the World Cup Trading Championships, has just given his 2025 prediction. Let's break it down. Larry Williams is one of the main reasons I got involved with the commitment of trader reports. So when that man speaks, I listen. Larry has titled his 2025 prediction as the good, the bad, and the ugly. But why? Starting with the good. The indicators that Larry uses suggest that no recession is on the horizon, pointing to employment as a big driver. In his eyes, strong employment equals a strong economy. Therefore, we need to keep a close eye on this. If the unemployment, however, creeps higher towards that 5% level, then that is typically bad for stock markets. Before we carry on, head down to the description. You'll see a link for our free newsletter. We discuss all macro topics from a week-to-week basis, giving you great insights into the markets. Now, seasonally, post-election, the first year of a new president is bullish for stock markets. Doesn't matter who's taken over. It could be a lizard, it could be a dog, it could be a cat. Stocks still typically perform well. But this isn't the only good thing. Larry then points us in the direction of another economic indicator, the current general business conditions, and briefly goes on to state that business conditions are good right now, which is typically good for Wall Street. Therefore, when I overlay the chart of the S&P 500 with this macro indicator, we can see that when it starts to turn down, there can be a period of bearishness for stock markets. When it turns up, there can be a period of bullishness for stock markets. And when it goes sideways, well, it goes sideways. Now let's move on to the bad. Larry offers the idea that the stock markets may be in an overbought condition, stating 2024 we had a strong market. Just to add to this, if we take a look at the S&P 500 chart, we can see that from low to high in 2024, it was up over 30%. Therefore, Larry says a lot of firms would have made a ton of profit. But what happens if they take profit? Well, sell orders can flood the market, causing price to turn lower, which we have seen over the past 2 to 4 weeks towards the end of last year. Let's take a look at the Dow Jones Industrial Average. Prices here fell 5% in the month of December alone. He also points out that selling could be delayed until the start of 2025 to postpone taxes. For that reason alone, stocks could have a bumpy start to the year. But we can't forget the elephant in the room, tariffs. Donald Trump is going to bring in tariffs this year, so understanding them is crucial. An example that Larry Williams gives us is shoes from Mexico. The retailer either pays the tariff or finds a new supplier with a better price. But that is the point of Trump's tariffs from his point of view. Either you work with the USA for better prices, or you get tariffed so that American made can be competitive. But Larry simplifies this further by breaking it down into 2 types of tariffs: outputs and inputs. Larry thinks that the tariffs on inputs will be a lot less than the tariffs on outputs, which makes a lot of sense. Anything that the USA need to bring in to make something would likely to be tariffed less than something that they sell out themselves. This could have a really big impact on industrial production. And Larry shows us that if industrial production falls, then a recession is likely following. For that reason alone, we should monitor industrial production on a monthly basis.
Because we need to see a pickup here. If this starts to roll over and come down, we're going to see trouble in the stock market.
Now let's get to the ugly. Larry really emphasizes 3 key points that make ugly viewing if you are a stock market investor. First, the Shiller-Cape ratio. Second, the Dow Jones PE ratio. Third, the yield on stocks. Larry highlights over the past 6 years, the PE ratio on the Dow has been 20.95 on average. And now the current 38.5 PE ratio is 54% higher than the average. Think about that for a second. Low PE ratio usually correlates with a rallying stock market. A higher PE ratio correlates with a stock market that goes down or sideways. Now we move on to the Shiller-Cape ratio, and in his own words, he says this is an index that you don't want to see high. The CAPE ratio is an acronym for cyclically adjusted price to earnings ratio and was popularized by Yale University professor Robert Shiller. It's a valuation measure that uses real earnings per share over a 10-year period. It's applied to equity indexes just like the Dow to determine whether it's overvalued or undervalued. And in Larry's eyes, it's overvalued. So Larry goes on and then talks about how he predicts 2025 to play out. Now he says that he expects another bullish year, but not to the extent that we've seen previously in 2024. A bullish market, but a messy one. Larry is an all-time legendary trader. I value his opinion very, very highly. And if there's a few things that I'll be watching in line with his suggestions, it's the unemployment rate, general business conditions, and industrial production. 2025 is expected to be a rocky year. So good luck, traders. I hope you have a fantastic one. And if you did enjoy this video, hit that like, subscribe, hit that notification bell for more deep dives into interesting macro stories.